kids, we're talking to Mr. Oil and Gas, Alex Ottewell. How you doing there, Alex?
How's it going? Doing good.
Oh, this is going to be fun because we're going to talk about oil and gas, ways to get our clients really, really rich. How does that sound?
There you go. I mean, that's why I transitioned, right? So,
dude, your background's way interesting. As you know, as we've talked about, our people that are watching and listening are mainly real estate investors. They're all really entrepreneurs. Most of them are, no, all of them are really well heeled. You know what I mean? They're the people you're after probably for one of your funds and et cetera. So let's talk about your background and kind of what your deal is, what you're looking to do. So talk real quickly about your background because it's cool. It's a really cool background.
Yeah. So, moved here when I was a kid from England in 2000. Parents emigrated here. Definitely entrepreneurial spirit. Started in the fix and flip era right out of the crash, kind of 2011 time. Went to the tax deed sales. Was a big tax deed buyer for 7.5 years. Bought about 650 tax deeds during that time. And then went into seller direct marketing, which is how I got my call center started. 2018 was around the time I was switching over, creating my own leads. I was getting about 2,000 leads a month with 8 cold
Holy
callers.
mackerel. Really?
Yeah. So at the time, my kind of niche in the market was mobile homes with land. So back in the day in the tax era, nobody wanted to buy them. So what I did was I went in and became the buyer for mobile homes with land, which locally I became known as like the king of trailers, which, didn't look too good when I had it on the, top of my Lambo. I had a king of trailers graphic on there. Yeah.
Wait a minute. Back up. Help me with a visual. Wait a minute. What? You had a Lamborghini, the car, right?
Yeah, baby blue Lamborghini Huracan, and I put King of Trailers in giant letters across the front of it. And the girlfriend I had at the time complained about it because she's like, it's cool driving around in a Lambo. It's not so cool that it says trailers on it. But
oh my God,
branding.
That's really fun. That's killer marketing right there, man.
Yeah, it raised a lot of questions. So went into the call center, did it, I was kind of using a service, a guy at the time, he had like 20 or 30 reps in the Philippines, kind of built it up further because he approached me with a partnership opportunity and I said, you know what, let's do it. He ran the operations in the Philippines and then I scaled the business side. I basically put in my SOPs, my own callers, call scripts, and just the way we were running it was a little different than his. It scaled really quick because I have an organic audience of guys that were interested in having cold call services. Built it to over 200 reps, 220 was our peak. And then we had about 30 managers between quality assurance, operations, team leads, things like that. Obviously, cold calling kind of died off a little bit in the middle of 22 when interest rates spiked. So that was around the time I actually got out of the business. So it worked out in my favor because we were, still doing okay. MGI Phone Services was the company. But going into 22, transitioned out of fix and flip. We between wholesale and fix and flip, I did over 1,000 projects. And at that time, I was like, okay, you know what? I want to do something different. I'm burned out, and learned about oil or heard about it and decided to kind of go all in on oil and gas.
Dude, you've got a background. So, okay, so now you're in oil and gas, although it's been a short time, but I'm sure you're doing well anyway. It sounds like you scaled quickly. So why oil and gas still? The question remains, why oil and gas versus, real estate? Because some people would say real estate's a pretty good spot when people are desperate right now and selling and you can buy low, sell high.
Yeah. So one thing I identified, anytime you're in any business, there's kind of peaks and valleys to things. And I kind of saw before 22 had that skyrocket of interest rate. I was kind of telling everybody around March and April, I was like, hey, I think interest rates are going to go from 2.5% to 8%. I think days on market are going to increase. I was just, when you're running a call center with that many agents, we were dialing millions of people a month, and I could easily see when our metrics were falling off, when people were being way more bullish about their prices. I was just looking at a lot of different metrics, and I kind of felt like, hey, it's going to be a rough year in 23. So I exited all my fix. We had like 25 projects going on whenever I decided to shut it down. And I was like, you know what? I don't want to buy anymore. we did some JV wholesale for a little bit, and then so got into oil and gas. But the kicker with oil and gas, it's in a generational change. If you think about it, the majority of the oil rush was it really got kind of hot and heavy in the 50s, 60s, 70s. It's definitely still there. Like, the industry's massive. But as far as independent operators, a lot of these guys are hitting kind of a retirement age. They're in their 60s, their 70s. It's happening in a lot of different industries. And these types of people are who built America. I mean, the truth of the matter is the current generation wants to find a shortcut to everything. They don't actually want to build a infrastructure company. They want to hit a freaking Amazon store and to rip $10 off their buddy instead of actually building a real business that benefits society. So
sadly, you're totally right.
Yeah. And I mean, I'm that era. I'm 33 years old. I mean, I haven't been around that long. I've just been self-employed for a long time. So I have a different mentality than most people in their 30s.
Totally.
It comes down to opportunity. Independent operators leaving the industry. There's a lot of extra money to be made. And also, if you can imagine, real estate, everybody picks the bones, right? Whether it's a wholesaler trying to get a good fee, fix and flipper, everybody's trying to take every dollar out of the deal. Oil and gas has a lot more left over that hasn't been touched. So that's what I'm really focused on. But yeah, sorry, that light was bothering me. It keeps flicking on. I don't know why. But yeah.
Dude, you've done a lot in your short little 33 years. Jeez, man, that's unbelievable. So then, yeah, I'm very busy. So if someone's coming to you, let's say with some dough to invest in oil and gas, how does that work? I'm wondering about the logistics, but also into what are they investing?
Yeah, I mean, early on, I didn't actually have a fund. We only just started the fund actually a month ago, OWP Capital Group. Originally, we're just using my buddy's money, my money, friends and families kind of stuff. But what we realized was that in order to really scale this up at the speed I want to do, we need additional capital. So the fund is $100,000 minimum, 506C, Reg D, accredited investors. Basically, we do a 10% preferred return. We do an additional bonus depending on cash flow for that quarter of up to 5%. So they can technically get about 15% a year. But then the additional value comes at the end. So our goal is to leverage the asset 70%. So we're using 30% fund capital and 30% fund capital, 70% debt. And then the structure is after 5 years, we paid off the debt. Now the asset's owned free and clear. The investors only put 30% in. If we tick up production 15, 20%, reduce the decline rate because oil wells decline. By that point, our assets probably worth 60 or 70% at the end. They're into it for 30. We split the profits.
All right, Alex. So as I was just about to say, it sounds as though you don't do the digging per se. You don't do the drilling, I should say. You just kind of do the next step after that. Can you explain a little bit about that? I'm going to ask some dumb questions. I have some wild questions, by the way, for you about some oil and gas. Go ahead if you can.
Yeah, so you kind of have to look at it in a couple of different realms. The guys that go out and drill, which is the majority of companies, their goal is to get that initial rush. If you almost compare it to a soda bottle, if you go shake up your soda bottle, that carbonation when you first open it sprays out like crazy. Well, then as like the minutes go by, the fizz dies off and it starts to not fizz as much. The ground works in the same regard. If you look at it, the earth is like layers of a cake. Depending on the pressures that you're dealing with in each formation, because each layer is a formation, you're going to have different results. So you're going to drill into the reservoir, and initially it's going to come on like crazy. And then over the next 12 months, it's going to start depleting. So you could get like 1,000 barrels a day initially, and then by the end of 12 months, it's doing 10 barrels a day or 5 barrels a day, whatever it may be. But what ends up happening is when you have a field, it'll get drilled by a lot of different wells. You get like 10, 20, 30, 50 wells drilled out over the course of however many years it is. And then after a while, those same operators, they hit a point where they're like, okay, I need capital to go do another field. So they'll sell their existing production to other people in order to go and do a new project. because drilling is quite addictive and probably one of the main reasons why I don't want to do it, because it's also the highest risk in the oil game, but it's also the highest reward. So it's kind of like gambling. What I did was I kind of went through maybe 10 different business models in the first 3 months of really kind of getting into oil and gas. I ran different variables, different scenarios, and I kind of wanted to look for what I did in real estate, the low hanging fruit. I don't necessarily want to go be that guy that has that crazy boom or bust type, drill. I'd rather buy existing production that I can kind of almost foresee the future in some regard. Because if you've got a well that was drilled 10 years ago and it's still doing 2 barrels a day, 3 barrels a day, whatever it may be, you can kind of see a track record much better than the first 12 months that you're drilling a brand new well. So having that consistency when it comes to evaluating and predicting your future revenue and things like that is a great way to be. It's easier to build a business model off of understanding what your production was the last 10 years and what it could be for the next 10.
Mm-hmm. And so what's a likely, this isn't the start of my dumb questions yet, by the way. So What's a likely rate of return? At least I'm telling you before. What's a likely rate of return for an investor? Because again, some of our people might want to, invest in oil and gas.
Sure. Yeah. So we put it between 18.5% and 22% IRR, and that's a net IRR after all our fees and stuff. There's also, every year that they own part of the fund with us, it's a depletion allowance. So you get 15% per year as a tax credit. So for example, if their return is, I don't know, 10 grand for the year, 20 grand for the year, whatever it may be, 15% of that return gets tax deducted because they're getting the pass through of the depletion. So the 18.5 to 22% IRR is not accounting for any kind of tax benefits too. It's just based on the cash flow.
That's important because a lot of our people, as you know, here at vastsolutionsgroup.com, we do tax, finance, and artificial intelligence, business automation. But one of our big things, a lot of people come to us for taxes. And so what you're just telling me, as an example, let's say someone made $10,000 in a year, meaning that's the rate of return with you guys. You're saying 15% of that growth would be basically tax deductible.
Right.
That's the term. In that case, it would be tax deductible. So it is a tax play. It's not only a rate of return play, if you will, but it's also a...
Yeah, and to be honest with you, it's our first fund. So I've always found in business, it's better to, give a lower estimation of where the returns would be, because the worst thing that can happen in the world is you come up short. So we deliberately structured it lower than we believe. Now, don't get me wrong. There's funds out there saying, hey, we'll get all your money back in 18 months. And that's based on a drilling proposition. Now, the cool thing with drilling is, hey, you get, 80%, 90% tax deduction with the tangible drilling costs. But the downfall with that is they don't really kind of outline the risk factor with you, right? Like most engineers will tell you that you got about a 50-50 shot of the well actually working the way it should. Maybe even less, maybe like 40%. So, it's a higher risk and a higher reward getting into the drilling side, but I personally would rather make a lower return and be consistent with it, because consistency is what builds a company for a long time, not a short time.
It's not, what are people after? Not, the rate of return, money on their money, they want their money back or something like that. All right, so it's time for me to ask some dumb questions. Okay, Here we go. So there's oil in the ground. I know they have engineers to try to figure out where the oil is, but there must be a massive art in trying to find that oil, because I can't imagine how bad it would be if they drilled down somewhere and got no oil 10 out of 10 times versus another guy or girl who somehow is getting 5 out of 10 or 10 out of 10. Now, I don't understand that risk parameter. Like, how is that possible,
So a lot of it's not just engineers, it's actually geologists. Geologists are probably the first person they send in when they're doing a kind of a reservoir analysis. They look at what's called offset wells, which is like neighboring wells, and see what their performance has been. But what you have to realize is the ground isn't kind of flat, right? So it's not like a layer of a cake in the sense that you've got each layer being the same depth. you could have the same formation, so the same reservoir, at one side of Texas being at 2,000 feet, and then in the middle of Texas being at 15,000 feet, or vice versa. So it depends on the curvature of how that basin is. You could be drilling into the same reservoir at two different depths, 100 miles apart. So a lot of it's understanding what the area that they're in, what kind of metrics they're dealing with underground. I'm no engineer. I just know when they're putting together reserve reports and things like that, they're looking at what the production is nearby, where the formations are at, and what kind of return they expect based on those conditions. The scary part with drilling and why the flaws happen is, if you can imagine, like I own wells in Texas, just outside of Austin, they're 15,000 feet deep. So they're 3 miles down into the ground.
Wow.
And then they're a mile, yeah. And then they're a mile laterally. So not only did we go down 3 miles, we also went sideways a mile when they drilled those. So imagine you're drilling something and the guy sitting up there with a joystick is half asleep. Well, when he's half asleep and he's off by a couple of inches at the top, by the time you get down 3 miles, you could be completely out of your zone, completely out of your land too. There's a lot of lawsuits that occur with guys that have drilled. They assumed they were drilling straight, but they were actually drilling sideways, and they ended up in somebody else's minerals. So
No way. Dude, that's awesome. I mean, not awesome, but you know what I mean. That's
not good for
crazy.
them. Yeah. And you think about it too, like the cost of that, the wells that we have, they were drilled back in 2008, 2009. Those cost $8 million then to drill. So, if you don't hit correctly, you're out $8 million per well. Now it's probably 14 or 15 million, to be honest.
To drill, bring out those A-shaped
well.
things. It's like
one well. Yeah. Yeah, because the rigs that you're talking about, because once you've drilled a well, the only thing there, it's either going to free flow, meaning the oil is just going to rush out of the ground, or you put it in secondary, which is like pump jacks, which honestly is a primary recovery because these days everything's on a pump jack. So when you see those pump jacks going up and down, they're almost squeegeeing the oil out of the earth, right? It's kind of like a siphon effect. You can have some good luck with drilling, you can have some bad luck. And sadly, it seems to be more bad luck than good luck. That's why I'm not interested in drilling personally.
Dude, okay, I have one more dumb question. So I can't believe I'm recording this. So how does it's like water underground basically, and it's in a basin, right? When I say water, liquid. I'm just using that as an analogy, right?
Yep.
But like how deep on average is a basin, if you will, physically? I know it's a weird question. You get what I'm saying?
Yeah. So there's oil wells as shallow as 800 feet, and then as deep as 20,000 feet. Typically, the deeper stuff is normally natural gas, because you get oil and gas out of the same wells. What happens is, though, depending on the formation you're in, you're going to have a primary, like gas will be the primary in that area and oil secondary, or vice versa. So after the initial production's kicked off for like 6 months, you're not going to get one of the components. It'll start to die off on one side, and that'll be your primary. But it's kind of like it's all trapped. Look at it as like a whole bunch of like, I don't know, sporadic cracks in it. All the oil's trapped down there. And then what we do is, when you drill it, you perforate the side of the well. So your casing goes all the way down, and you're firing off this almost dynamite into the side to blow open holes into the rock. And then that allows the gases to escape up the well. But there's a lot of factors that come into play, just like fracking, right? Fracking gets a lot of hell for things, but all fracking is they're using intense pressurized water and sand and some other chemicals in order to wedge open these fractures to allow the oil and gas to rush up quicker. I mean, that's like the dumbed down answer of what it does.
Holy mackerel. Dude, I could ask questions about
it's just a squeeze. It's to squeeze more production to the surface.
And the better you are, the lower the risk, the higher the rate of return, hence where you come in.
Yeah. So, I mean, just think of me as like the guy that goes around and buys rental portfolios in real estate, but we buy them from tired landlords. They don't want to put the money in. and we go in and we optimize them. It's not as simple as that. I mean, real estate is like way easier. Oil and gas is all about quality engineers, quality geologists, understanding the formations, understanding the areas. I mean, I couldn't optimize the fields personally with my realm of knowledge. I mean, I definitely understand enough, but I rely heavily on my engineers and geologists to really identify where we're going to increase production at.
I get it. That's a killer. That's the exact analogy I was thinking of. You could buy real estate, income producing real estate, or in your case, buy income producing real estate that actually is gas oriented, oil and gas oriented. And there's probably a massively mass downside, mass upside over here. Here, relatively speaking, now that I'm figuring out, low downside, low upside. I mean,
buying the right
the
assets.
difference is unbelievable. What?
Yeah, it's buying the right assets. So a lot of our time, like we've probably combed through about 500 deals, and only 20 of them have been viable candidates to purchase. There's a couple of things I kind of left out, but like February of this year, just over a year into the industry, I was the main sponsor at the largest oil event in the world. So
yeah, how have you done what you've done? You're a little kid, man. That's unbelievable. That's pretty impressive.
Yeah. So we scared some people doing it because we're brand new, and went in there and did this crazy 2-story booth, and Marathon was there, BP was there, Exxon, all the big boys. So we grabbed a lot of attention from it, and then I actually just got featured in Nape magazine, which is a big oil and gas magazine. They featured me as CEO. But these types of things I've been doing is because we've been disruptive with how we're marketing ourselves. I want to be loud. I want to be out there because operators that I haven't known for 50 years, they don't know who the heck I am. We're not going to do business. That's the way the industry works. It's a very mom and pop oriented kind of business.
And I get that, by the way. I think I get that. I'm sure the people are like that. I know you don't like that. I bet you a bunch of people don't like that, but I'm sure in that industry, it kind of makes sense.
Yeah, it's different because even on software and stuff. I was talking to a guy this morning who's a software developer, and oil and gas is about 20 years behind on software. Like as far as
it's one of those.
As far as the industry's evaluations and how they do the like economics and geology stuff, all those softwares are really old. They're very out of date as far as how the UI looks, how they interface. I mean, they're kind of old school.
Let me guess, no AI.
No, there's a couple of companies that are coming in, and we're definitely doing AI in-house, but that's because I have a background in software configuration stuff. I mean, not necessarily coding, but I definitely know how to, utilize tools. But it's really behind. And then the cost is astronomical. I mean, our fees per year just for running a small company, they're nearing $200,000 a year just in software subscriptions.
Just in software? Are you serious? Yeah.
Yeah.
Holy.
Yeah, and then you gotta tack on a couple of engineers at $200,000 a pop, and realistically, just to run a mom and pop operation, it's about $1 million a year. Just a very tiny operation. It's about $1 million a year in hard costs.
And I'm sure that scares off everyone. So the only players are big dudes, right? Generally.
Yeah, well, no, I mean, a lot of these mom and pop operators, they started in the 50s. They drilled their first well. They drilled another one. I was talking to a gentleman. He's been in the game for about 35 years. He's got 9,000 wells, and he's never taken a piece of debt in his entire life. All he did was he took one well and took the profits and drilled another one and another one until he had 9,000 of them. I mean, he bought out other companies at that point, but he did a bootstrap method, which is very common. I personally don't believe in bootstrapping to that level of scale. My goals are to control and own a sizable portfolio in oil to the point where you get bought out. I'm not being delusional in the fact that I want to be the next Marathon. I just want to be the guy that everybody sells deals to for now. I roll it up into one pretty package and then sell everything to them in a bulk, $1 billion.
Well, that makes sense. And by the way, what I meant was the new players would be bigger companies versus mom and pop. That's what I meant to say.
Yes.
Is that not the case?
100%.
Oh, okay. That's what I thought. Okay, yeah.
There's probably less than 10 people a year that are becoming independent oil and gas operators. Like, it's very low.
That's what I thought.
Yeah.
Yeah.
There's only 10,000 in the whole industry in the United States for upstream, which is what we do. There's probably only 10,000 active operators. in the entire United States. And there's 5.5 million wells in the United States.
Yeah. How many?
5.5 million wells.
Oh, it's a lot more than I expected. Holy mackerel.
Yes.
Um,
Yeah.
yeah. All right. One more dumb question. I should know this. What's the oil pipeline that's so?
Keystone.
Yeah, exactly. Keystone.
Yeah.
What are your thoughts on that? I don't. If you don't want to get political, I get it, dude. But you know what I mean?
Well, the original goal behind it was to transport from Canada. So Canada, every oil, and I could be incorrect on the thickness, but typically like Canada has a thicker viscosity oil, and we have a lighter crude in Texas. So what happens is our refineries were kind of getting set up for having a mixture of light crude and heavy crude. So what they were doing was they were trying to bring in Canada's oil to mix with our oil to make a better combination. That's from my understanding. Bear in mind, I don't have an engineering background, but from what I've talked about with different engineers I have and stuff, that was kind of the goal was to make our plants run more efficiently by utilizing their oil too. But Canada's got really rough. Like I know a Canadian company up there that drill in Canada, and they have a lot more issues with extraction just based on the viscosity of their oil. It's a very heavy pain in the ass oil to get out of the ground. Same as Venezuela.
So it'd be more difficult, more expensive.
Yeah, it's the same as Venezuela. Venezuela's oil is considered dirty oil. It's not. It's hard to extract, and they have a ton of oil, but it's very expensive to extract the way they do it.
One more dumb question. If it's literally there's these pipelines, right? Literally huge pipelines. I can't imagine why they're not attacked more so by either environmentalists or forbid, terrorists. You know what I mean?
Yeah. Yeah, I think you're probably more pointing to like natural gas pipelines, right?
Well, both.
Like,
Yeah, both. Yeah, probably more.
Yeah, because typically oil is trucked off, meaning that
Trucked. Yeah,
like,
that's true too.
There's definitely pipelines for some oil fields we've even encountered have direct access. Like they have a pipe that runs directly to the refinery, depending on the production volumes. But majority of the time, how it works is the oil comes out of the ground, they put it in a tank battery, and then once a month, once a week, once a day, depending on the field's production, they're going to come by and pick up that oil and then transport it by truck. Natural gas is typically flowed through pipelines. And the kicker is, most people don't know this, like I have 8 natural gas wells. When they flow out of the ground, that gas runs through my pipeline into the main pipeline, right? Well, whenever they run it through their pipeline, they're going to charge me based on the distance from me to the refinery. So they charge me a fee,
that makes sense. Okay.
Depending on where we're going through, yeah. And then based on the gas composition, you're going to get different fees involved. But to go back to your original question of why it's not attacked, I have no idea, but I could at least give you an explanation of what goes on with those pipelines. They're a pain in the butt, though. I mean, I've had 2-3 weeks at a time where they've been down. Like if they have a leak or an issue,
I didn't even think about that.
Down. Yeah, they got to shut them down, and then you can't sell your natural gas. So then you have to shut in your wells because you can't have thousands of pounds of pressure sitting there. So we have to shut them in, which in essence loads up the water in the well because it's called water loading. But the formation, if you can't get rid of the gas, it basically starts pushing water into your well, and then it becomes another costly exercise to get that out. So,
oh my, I could talk for you all day. Okay, I'm gonna try not to ask any more dumb questions. Plus, we gotta probably close up. All right. So, what's something we haven't talked about thus far that you wish a potential investor or someone who's interested in your world should know that we haven't talked about?
Yeah, I mean, I think if they're thinking about going into oil and gas, right, as far as an investment or whatever, because truth of the matter, I mean, most of the deals we're looking at are between $10 and $15 million or more. So like, unless they have that kind of pocket change sitting around, they're probably not going to go buy an asset like we are. But the goal behind it is, I created a vehicle for people to get into oil and gas that are afraid of only getting a tax benefit, right? If you go drill a well and you get a tax credit, that's great. But if you're not getting back your original investment, you're at a loss. So I create a vehicle for people to invest in that don't necessarily want to make, their money back in 18 months because they don't think that's realistic, but they do want to make a considerable return, So I think if you're looking for somewhere to park money in oil and gas and you want something consistent, not necessarily boom or bust, then we are a good vehicle. If you're a dice roller and you're the guy to walk in, put 10,000 on black, then go for it. I'm just not that kind of investor. So there's our biggest difference.
Yeah. Yeah, no, I totally get that. I think I could totally see some of our clients or viewers, listeners liking what you do, because for one, your rate of return, I would say, is pretty good. Number one. Then number two, a little bit of a tax benefit. It sounds like you're an interesting dude. Like, what's going on in the marketplace.
Yeah.
You're, disruptive,
My goal is to hit that return. And I think one of the things people are really concerned about is commodity pricing, because, clearly we had like a 2020, oil went negative, blah, blah, blah. But what they have to realize is that only happened for a few months, and then things regulated themselves and went back up to $40, $50 a barrel and so on and so forth. But the way I'm able to hedge our production to stop us from having that kind of issue, we'll take let's say we get up to 100,000 barrels a month, right, in production. We'll take 25% of that portfolio and go ahead and hedge it, which means locking in the rate. It'll be a lower rate. So let's say oil's at 80 and we lock in at 65. The goal behind that is to keep us, we'll lose money if we, as far as opportunity value, but it'll also protect us if everything goes to crap, then we're still locked in for that rate. So there's a few different things we're doing that are pretty standard, but also not talked about. I think one of the problems in oil and gas and why everybody likes me, and as far as NAPE and these other magazines that are featuring me, is because I'm coming out and saying, hey, we're going to be open and transparent about what happens in oil and gas when everybody else just wants to keep it a secret. I'm the guy that's not keeping it a secret how it operates. I mean, if you go on my Instagram, Alex.Ottewell, I post tons of videos literally breaking down how the industry works. How things are decided and what the risks are. The more transparent you are with risk, I think is important in anybody trying to get into a new industry. You got to be honest about the risks. That's where a lot of these guys
100%.
get a bad name. Yeah. So
it's the downside we have to worry. Yeah, it's the downside you have to worry about. I mean, especially on investors. And we deal with a lot of people or whatever in their 50s, 60s. They've amassed whatever $20 million. They don't want to all of a sudden lose it. You know what I mean? They'd rather do something, minimize the risk to the extent possible. And what I would also say is, as I'm thinking this through, at least a portion of the portfolio potentially could be earmarked towards this. I mean, 18, 19, whatever % rate of return. Plus on top of that, the tax benefit, it really might make sense for some investors.
Yeah, I mean, we're an alternate investment. I mean, like you can look at real estate and stock market; they're pretty correlated together. Oil and gas, I mean, because it goes into so many different sectors. A lot of people think of oil just as gasoline. That's a very standard response, but there's over 6,000 products that are made, or different types of products that are made from oil and gas. So you got 6,000, like the clothing, makeup, plastics, just as examples.
Everything.
Yeah. So like people really kind of get a very narrow mindset with oil and gas, but you got to realize, regardless if EV becomes the only vehicle on the planet, 65% of the oil barrels go into something else. So
people have to remember that. You're right. That's a huge point. Huge point. So how does someone, let's say someone's interested in doing your deal? You mentioned your Instagram, but how else do they get a hold of you? Do you have a website, etc.?
Our website is investinpetroleum.com.
Can you spell that? Because believe me, I wouldn't be able to spell that. Go ahead and spell it.
INVEST at. Oh, I'm sorry. Invest in petroleum is PETRELEOUM. There you go. I got that right. .com.
Sweet, man. He is Alex Ottewell. I'm Kenner French with VastSolutionsGroup.com. We're speaking here, Vast Voice, telling business secrets to entrepreneurs. Man, if this isn't interesting to you, you're crazy. Because man, this is a way to make money and save some taxes all at the same time. It's pretty good. I would say reach out to Alex. I think it's interesting stuff. Once again, I'm Kenner French. Thanks everyone for hanging out with us, chatting a little bit. That's man.